Most traders believe a small trading account is their biggest obstacle. They look at the number on the screen and immediately feel limited. $5,000 feels small. $10,000 feels like it will never be enough. And in that moment, a quiet pressure begins to build inside the mind. The pressure to make it grow quickly. The pressure to prove something. The pressure to escape the smallness of that number. But here is the uncomfortable truth that most traders never consider. Small accounts rarely fail because of strategy. They fail because the human mind struggles to tolerate slow progress. The brain is not naturally designed to wait months or years for reward. It evolved to react quickly to threats and opportunities. When you sit in front of a trading platform watching small price movements and small position sizes, your nervous system begins to feel restless. Nothing dramatic is happening, nothing exciting is happening. And slowly, the mind begins searching for stimulation. This is where the first psychological fracture appears. A trader opens a small account and tells himself he will be disciplined. He will risk carefully. He will follow his rules. But after a few weeks, something inside him starts to whisper. The progress feels too slow. The gains feel too small. The market looks full of opportunities that seem bigger than the ones he is taking. The nervous system interprets slow growth as stagnation. And when the brain senses stagnation, it pushes the person toward action. This is why many small accounts disappear so quickly. The trader is not destroyed by the market. He is destroyed by his own need for acceleration. He increases his risk slightly. Just a little more per trade. It feels harmless in the moment. After all, the account is small. The loss will not be catastrophic. But what the trader does not realize is that he has just changed his relationship with risk. Now every trade carries more emotional weight. Every price movement feels more important. The nervous system becomes more alert, more reactive. Decisions that once felt calm now feel urgent. The trader begins watching the chart more closely. He feels a subtle tension while waiting for trades to move. When the market hesitates, he feels doubt. When a trade moves against him, he feels irritation. When a trade moves in his favor, he feels excitement. This emotional stimulation becomes addictive. Without realizing it, the trader begins chasing the emotional rhythm of trading rather than the discipline of execution. More trades appear on the screen. Setups that once looked questionable suddenly look acceptable. Rules that once felt clear begin to feel flexible. At first, nothing seems wrong. Sometimes the trader even experiences a short period of rapid gains. Those gains reinforce the behavior. The mind interprets them as proof that increasing risk was the correct decision. But the nervous system does not understand probability. It only understands emotional intensity. Eventually, a losing streak appears. Losses now feel larger than before. The trader feels pressure to recover. And once recovery becomes the goal, discipline quietly disappears. This cycle repeats again and again for thousands of traders. They believe the problem is their system. They search for new strategies. They change indicators. They adjust time frames. But the deeper problem remains untouched. Their nervous system cannot accept the pace at which real capital grows. Professional traders understand something that most beginners overlook. The market does not reward speed. It rewards emotional stability. When a trader risks a very small portion of his account, something interesting happens inside the mind. The emotional noise begins to disappear. The brain no longer perceives every trade as a survival event. The nervous system remains calm enough to observe rather than react. From the outside, this looks like patience, but internally it is something much deeper. It is regulation. A regulated nervous system allows the trader to see the market clearly. Decisions are made from observation instead of urgency. Losses feel manageable. Wins feel ordinary. The emotional spikes that once drove impulsive behavior begin to flatten. This is why disciplined traders grow accounts slowly at first. Not because they lack ambition, but because they understand what happens inside the human mind when risk becomes too large. Survival always comes before growth. If a trader cannot remain emotionally stable through losses, he will eventually sabotage his own performance. Not through lack of intelligence, but through psychological fatigue. The nervous system eventually reaches a point where it seeks relief from stress. That relief often appears in the form of impulsive decisions. closing trades early, moving stop losses, increasing position size, entering trades that were never planned. From the outside, these behaviors look irrational, but internally they serve a purpose. They release emotional tension. The market becomes a place where the trader tries to regulate his own feelings, and once trading becomes emotional regulation, profitability becomes almost impossible. Disciplined traders approach the process differently. They do not attempt to force rapid growth from small capital. Instead, they focus on building a psychological environment where consistent decision-making becomes possible. They reduce risk to a level where the nervous system remains quiet. They accept that progress will appear slow. They resist the urge to constantly interact with the market. Over time, something subtle begins to change. The trader's identity shifts. In the beginning, the trader measures success by how much money is made. Each trade feels like a test of intelligence or ability. Wins create pride. Losses create frustration. But when risk remains small and consistent, the emotional intensity fades. Trades stop feeling like personal verdicts. They become simple executions of a process. This shift is extremely important. When a trader no longer needs each trade to prove something, discipline becomes easier to maintain. Decisions stop being driven by ego and start being guided by observation. Ironically, this is the moment when performance begins to improve, not because the trader discovered a better strategy, but because the mind finally became quiet enough to follow the one he already had. Most traders never reach this stage because they are constantly trying to accelerate the outcome. They believe increasing risk will speed up success. In reality, it usually speeds up emotional instability. A small account is not a limitation. It is a psychological training environment. It exposes how a trader reacts to uncertainty. It reveals how the mind behaves when progress is slow. It shows whether discipline exists only in theory or whether it can survive real financial pressure. If a trader cannot maintain stability with small risk, larger capital will only magnify the instability. The habits that appear at $5,000 rarely disappear at $50,000. They simply become more expensive. Disciplined traders understand this deeply. They treat small accounts as the place where emotional control is built. Each trade becomes a rehearsal for larger responsibility. Instead of asking how quickly the account can grow, they ask a different question. Can I remain consistent long enough for growth to occur naturally? This question changes everything. Because once survival becomes the priority, time begins working in the trader's favor. Once a trader begins to survive consistently, a different psychological challenge appears. It is quieter than the urge to grow quickly, but it is just as powerful. This challenge is boredom. When risk is small and trades are taken only when conditions are clear, the market becomes far less stimulating. Long periods pass with very little activity. Charts move slowly. Days end without dramatic gains or losses. The emotional spikes that once made trading feel exciting begin to disappear. For the nervous system, this can feel strangely uncomfortable. The human brain is deeply sensitive to stimulation. When activity drops, the mind begins searching for ways to create engagement. This is the moment where many traders begin quietly sabotaging themselves. A trader who once promised to take only the highest quality setups begins noticing opportunities that previously would have been ignored. The reasoning sounds logical in the moment. The market appears active. The trade seems acceptable. The rules begin to feel slightly flexible. What is actually happening inside the mind is far more subtle. The nervous system is attempting to create stimulation. A trade is not just a financial decision. It is also an emotional event. When a trader enters a position, attention sharpens. The brain releases chemicals related to anticipation and uncertainty. Even a small trade produces a noticeable shift in mental energy. This shift can become addictive. When trading becomes the primary source of stimulation during the day, discipline slowly erodes. The trader begins seeking that feeling again and again. More trades appear. Decisions become quicker. Reflection disappears. From the outside, it appears as overtrading. Internally, it is the brain searching for engagement. Disciplined traders recognize this pattern early. They understand that boredom is not a signal that more trades are required. It is simply the nervous system adjusting to a slower rhythm of decision-making. Professional trading often feels uneventful. Long periods of waiting are normal. Markets move through cycles of opportunity and inactivity, and forcing participation during quiet periods rarely leads to good outcomes. Learning to tolerate this calm state is one of the most important psychological developments a trader can experience. At first, the silence feels uncomfortable. The mind wants to interfere with the process, but gradually the nervous system adapts. The trader becomes less reactive to every movement in the market. Attention becomes more selective. Decisions become slower and more deliberate. This shift marks the beginning of real discipline. Something else also begins to change as consistency develops. The trader's perception of risk evolves. In the early stages of trading, risk is usually viewed in terms of money. A trader thinks about how much can be made or lost from a single trade. Each position feels like an opportunity to improve financial circumstances. But as experience grows, the meaning of risk becomes more psychological. Risk is no longer simply about losing money. It becomes about losing emotional stability. A disciplined trader understands that one impulsive decision can disrupt weeks of consistent behavior. One moment of frustration can reopen habits that took months to control. Protecting psychological balance becomes just as important as protecting capital. This is why experienced traders are often extremely conservative with position size even when their accounts grow larger. They understand that the mind responds to numbers emotionally, not mathematically. If a trader is comfortable losing $50 on a trade, that loss barely registers in the nervous system. But when the same percentage risk becomes $5,000, the emotional impact changes dramatically. Even if the logic remains the same, the brain perceives a larger threat. The body reacts with subtle tension. Attention becomes more focused on the outcome of the trade. The trader may begin watching every tick of the market, waiting for confirmation that the decision was correct. These reactions are not signs of weakness. They are normal responses to increased exposure. The key difference between disciplined traders and struggling traders is how they adapt to this change. Undisciplined traders often increase position size quickly when their accounts grow. The profits feel encouraging, and the temptation to accelerate growth becomes strong. But when risk expands faster than psychological adaptation, emotional pressure begins to build. Losses feel heavier. Doubt appears more easily. The trader starts questioning decisions that were once simple. Confidence becomes unstable. Eventually, the behavior that created the growth disappears. The trader who once executed calmly now hesitates or reacts impulsively. Disciplined traders approach this transition very differently. They understand that emotional exposure grows with account size. Larger numbers naturally carry more psychological weight. Instead of increasing risk aggressively, they allow their nervous system time to adapt. The growth of capital becomes slower, but stability remains intact. This gradual process allows the trader's mind to normalize larger numbers. A loss that once felt uncomfortable eventually feels ordinary again. Emotional reactions settle. Decisions return to the same calm state that existed when the account was smaller. This is how professional traders maintain discipline, even when managing large capital. Their psychology evolves alongside their account size. Another important transformation begins during this stage of development. Responsibility begins to expand. In the early stages of trading, decisions affect only the individual trader. The consequences of mistakes remain private. A losing trade may feel frustrating, but it does not carry external expectations. As performance becomes consistent, opportunities often begin to appear. External capital, funded accounts, or investment partnerships become possible. Suddenly, trading decisions represent more than personal outcomes. This change introduces a new psychological layer. When a trader knows that other people are trusting his decision-making, the sense of responsibility becomes stronger. Some traders respond to this pressure by becoming overly cautious. Others react by trying to prove their ability through aggressive performance. Both responses can destabilize discipline. The traders who adapt successfully understand that responsibility does not change the fundamental process of trading. The same behaviors that created stability with small accounts remain necessary with larger capital. Careful risk, consistent execution, emotional regulation. External capital does not require a different personality. It requires the same discipline applied at a larger scale. This is why traders who develop strong habits early often handle growth much better than those who focus only on profits. Their identity has already shifted. They no longer see themselves as individuals trying to win in the market. They see themselves as decision-makers responsible for managing uncertainty. Each trade becomes part of a larger process rather than a personal test. This perspective removes a great deal of emotional pressure. Wins and losses are no longer interpreted as proof of talent or failure. They are simply outcomes within a probabilistic environment. And once the mind accepts that reality, consistency becomes much easier to maintain. As the trader continues operating within this calmer psychological state, another transformation slowly begins to unfold. It is less visible than risk management or trade execution, but it is often the factor that determines whether a trader improves over time or remains stuck repeating the same mistakes. This transformation is awareness. In the beginning stages of trading, most decisions happen automatically. The trader believes he is following a plan, but many of his actions are driven by emotion without his conscious recognition. A trade is entered slightly earlier than intended. A stop loss is moved to avoid discomfort. A position is closed too quickly after a small profit appears. Each of these decisions feels justified in the moment. The mind creates explanations that make the behavior seem logical. But beneath those explanations, emotional impulses are quietly guiding the outcome. Without awareness, these patterns repeat endlessly. This is why disciplined traders spend significant time observing their own behavior. They treat their own decisions as data, not in a judgmental way, but in a curious way. They want to understand how their mind behaves under uncertainty. After a trade is finished, they examine not only the outcome, but also the internal state that existed during the decision. Was the trade taken calmly or with urgency? Was the entry planned or slightly impulsive? Was the exit executed according to the original plan or influenced by fear? Over time, these observations begin to reveal patterns. The trader may notice that impulsive trades often appear after several hours of staring at charts. He may notice that losing streaks tend to occur on days when frustration from earlier trades was still present. He may even discover that some trades were taken simply to escape boredom. These insights are extremely valuable because they expose the real drivers behind behavior. Most traders assume their results are determined entirely by market analysis. But careful observation often reveals that emotional conditions play an equally powerful role. When a trader begins recognizing these internal patterns, something important happens. The gap between impulse and action becomes slightly wider. Instead of reacting immediately to emotional signals, the trader becomes capable of noticing them first. A feeling of urgency appears, but instead of acting on it automatically, he recognizes it as a temporary emotional state. That moment of recognition creates space. Within that space, the trader can decide whether the action truly belongs to his strategy or whether it is simply a response to internal pressure. Many impulsive trades disappear during this moment of reflection. This ability to observe one's own reactions is one of the defining characteristics of long-term successful traders. It does not eliminate emotion. Emotions continue to appear in every uncertain environment. But awareness prevents those emotions from controlling behavior. As this skill develops, the trader's relationship with mistakes also changes. Early in the trading journey, mistakes often trigger frustration. A losing trade can feel like proof that something is wrong with the trader's ability or intelligence. The emotional reaction sometimes leads to further impulsive decisions in an attempt to recover quickly. But once awareness grows, mistakes begin to serve a different purpose. Instead of feeling like personal failures, they become signals that reveal weaknesses in discipline or attention. A rule violation becomes information. A poorly timed trade becomes a clue about emotional state. This shift removes much of the emotional charge from mistakes. The trader becomes more interested in understanding behavior than in defending his ego. Ironically, this mindset leads to faster improvement. Because when the ego stops protecting itself, learning becomes easier, patterns become clearer, adjustments become more precise. Over time, the trader begins to refine his behavior in small but meaningful ways. Perhaps he reduces the number of hours spent watching the market to prevent fatigue. Perhaps he limits the number of trades per day to maintain focus. Perhaps he avoids trading when emotional tension is already present. Each adjustment is small on its own, but together they gradually reshape the trader's decision environment. Consistency does not appear suddenly. It emerges from the accumulation of these small behavioral corrections. This is also where the idea of compounding takes on a deeper meaning. Many people think of compounding purely in financial terms. They imagine profits being reinvested again and again until the account grows significantly. While this mathematical effect is real, there is another form of compounding that happens internally. Behavior compounds. A single disciplined decision may seem insignificant in isolation. But when similar decisions are repeated day after day, the effects multiply. Emotional stability becomes stronger. Confidence becomes grounded in experience rather than hope. Eventually, the trader reaches a stage where discipline no longer feels forced. It becomes part of identity. The person who once struggled to follow simple rules now finds that those rules are followed automatically. The nervous system has adapted to a slower and more stable rhythm of trading. At this stage, something interesting happens with the perception of profits. In the early days of trading, financial gains feel exciting. Each profitable trade creates a burst of satisfaction. The trader imagines what those profits might eventually become. But as discipline strengthens, the emotional meaning of profits begins to change. A profitable trade no longer feels like a victory over the market. It simply feels like confirmation that the process was executed correctly. Losses feel similar. They are accepted as normal outcomes within a probabilistic system. This emotional neutrality is often misunderstood by new traders. It can appear as if experienced traders have lost their enthusiasm. In reality, they have simply stopped depending on individual outcomes for emotional reward. The satisfaction now comes from something different. It comes from maintaining clarity under uncertainty, from following a process even when outcomes fluctuate, from knowing that decisions are aligned with long-term survival. This form of satisfaction is quieter, but far more stable than the emotional highs and lows that characterize early trading experiences. And it creates the psychological environment where consistent performance becomes sustainable. At this point in the trader's development, the relationship with the market begins to look very different from the way it looked in the beginning. In the early stages, trading often feels like a struggle for control. The trader wants the market to behave in a certain way. He wants his predictions to be correct. When the market moves against him, frustration appears. When a trade wins, relief follows. The entire experience revolves around outcome. But as discipline and awareness mature, the trader slowly realizes something that changes the entire perspective. The market was never meant to be controlled. It is simply an environment of uncertainty. Prices move according to forces far beyond any individual trader's influence. News events, global capital flows, institutional positioning, and countless other factors interact continuously. Trying to dominate such an environment through prediction alone eventually becomes exhausting. Disciplined traders stop fighting this reality. Instead of trying to control the market, they focus on controlling their own behavior within it. This shift removes a large amount of psychological pressure. When the trader accepts that outcomes cannot be controlled, the mind no longer wastes energy trying to force them. Attention moves toward the only variables that are truly manageable: risk, execution, emotional stability. These three elements become the foundation of professional behavior. Risk defines how much exposure the trader accepts. Execution defines how consistently the strategy is applied. Emotional stability determines whether those two elements remain intact under pressure. Everything else becomes secondary. This is the stage where trading begins to resemble a long-term craft rather than a short-term opportunity. The trader no longer approaches the market with urgency. There is no need to rush the process because the focus has shifted from immediate profit to long-term survival. Time becomes an ally instead of an enemy. Many traders struggle to adopt this mindset because modern culture celebrates speed. Quick success appears impressive. Stories of rapid wealth spread easily and create the illusion that markets reward aggressive behavior. But the reality experienced by disciplined traders is very different. Real progress in trading often appears quiet and gradual. Months pass with modest growth. There are periods of drawdown and periods of recovery. The overall trajectory slowly rises, but the movement is rarely dramatic. To an impatient mind, this path can appear unremarkable, but over longer periods, the results become powerful. Consistency allows mathematical compounding to operate without interruption. A small percentage gain repeated steadily over years begins to produce significant capital growth. What once looked slow eventually becomes substantial. More importantly, the trader who followed this path arrives with something far more valuable than a large account. He arrives with a stable psychological framework. This framework allows him to operate under conditions that would overwhelm most participants. Larger numbers no longer create panic. Losses do not trigger emotional spirals. Wins do not inflate ego. The trader remains balanced because his identity is no longer attached to individual outcomes. He sees himself as a decision-maker working within probability. From this perspective, the market becomes less intimidating. It is no longer an opponent that must be defeated. It is simply an environment where disciplined behavior produces favorable results over time. This understanding also changes how the trader views opportunity. In the beginning, every market movement appears urgent. The trader feels that missing a trade means losing a chance to make money. This fear creates pressure to participate constantly. But once discipline becomes stable, patience becomes natural. The trader knows that opportunities will continue appearing in the future. Missing one trade does not threaten the long-term process. There will always be another setup, another moment when conditions align with the strategy. This patience protects the trader from one of the most destructive habits in trading, the need to always be involved. Instead of forcing activity, the disciplined trader waits for clarity. When the market offers conditions that match the strategy, he acts. When those conditions are absent, he remains still. This rhythm of action and restraint keeps emotional stress low and decision quality high. Over many months and years, these behaviors accumulate into a professional identity. The trader who once chased excitement now values stability. The person who once feared slow growth now understands that slow growth is often the most reliable form of progress. Most importantly, the trader recognizes that success in the market was never purely about strategy. It was about becoming the type of person who can operate calmly inside uncertainty. The market constantly tests patience, discipline, and emotional control. Those who attempt to overpower these challenges through speed usually burn out quickly. Those who adapt their psychology gradually become stronger within the environment. This is why small accounts can be such powerful teachers. They expose impatience. They reveal emotional reactions to risk. They show whether discipline can survive boredom, uncertainty, and temporary losses. If those lessons are learned early, the trader builds a foundation that can support far larger responsibility later. Capital can grow. Opportunities can expand. But the internal stability remains the same. And in the end, this stability is what allows a trader to stay in the game long enough for success to compound. Because trading is not simply a method of making money. It is a long process of learning how to remain calm while navigating uncertainty. It is the gradual development of patience, self-awareness, and disciplined decision-making. Once those qualities are established, capital growth becomes a natural consequence of behavior rather than the result of constant effort. The trader no longer needs to chase success. He simply continues following the process that allowed him to survive in the first place. And with enough time, survival turns quietly into prosperity.